our first speaker for the day, CA TG Suresh, on the desk, please. I request all delegates present here to please rise for the ICA motto song. A very warm good evening to one and all present here. I welcome you to the annual public budget program that our CA Institute organizes. And as you're all aware, today the budget was presented by the Honorable Finance Minister. A lot of expectations, and there were some very good changes. Some changes which we felt could have been introduced, but maybe it will come a little later. But overall, I think there is fair to say a mixed response from the budget. But as always, this is the sort of budget is something where you cannot please everybody. One person's perspective will be completely different from another person's perspective. But the Sensex, you can say, reflects the mentality or what seems to be the view of people in the business. So the Sensex has crashed by almost 1,000 points today. And while the Finance Minister does have a view that it will again bounce back on Monday morning, we shall wait and see. Because today we have the best speakers on both the matters. We'll be covering direct tax and indirect tax issues. CA TG Suresh and CA or Advocate Vaidishwaran sir. Both of them are excellent speakers on the topic, and I'm sure they'll dwell a little bit more in detail. There are a few points that I thought I'll quickly touch upon before our expert goes into detail. There were a few really good changes in terms of abolishing the dividend distribution tax of corporates. Now they're only going to charge in the hands of the final consumer or the assessee himself. It will not be charged in the hands of the corporate. So combined along with the earlier announced tax rate cut for corporates, this is a very big move and will prove beneficial to corporates as a whole. The next important change, and I'm sure it will affect all of us who must currently be getting a lot of calls from your assessing officer saying, please ask your assessee to pay the tax, sir, please ask him to pay 20%, sir, please ask him to pay last year's tax, we are going to attach the property, we are going to freeze the bank account. All these threatening actions are happening. So we all are aware. These are instructions which have come from the top. Assessing officers are merely executing whatever is being told to them. And I think the Finance Ministry has taken cognizance of this, where they have announced a dispute resolution scheme, where if you pay by 31st of March, you can resolve the dispute, merely pay the tax, the quantum. They are saying the interest and penalty will be avoided, which is a huge beneficial move for assessees as a whole. And given the current scenario of high litigation which is happening, as she quoted, more than 483,000 cases are currently in litigation as far as income tax is concerned. So given this backdrop, I'm sure it will be a very useful move. Of course, there are some questionable moves as well. One, for example, LIC, that's the most prominent thing that stands to my mind. Some of you may be aware, you would have received the news that yesterday, 31st, was the last day for multiple schemes of LIC, and they had a record collection of more than 12,000 crores on a single day. LIC yesterday registered more than 12,000 crores as a collection. The belief that investors put in LIC is that it will be a sovereign bond or a sovereign investment. It will be ruled by the government only. It will never go diwal. It will never go diwal. That is the belief that people have put their money in. But today the finance minister announced that there will be divestment. Divestment of Air India separate, shipping corporation is different, where the people who have put their life savings will not be affected, where Air India is divested, etc., to private people. But when LIC is divested, especially there are schemes where people have to pay for almost 30 years, 25 years, and then they will benefit for a period of 100 years. For 100 years, till the age of 100, LIC was giving schemes where pension will be given to these people. So questions will naturally be arised. Will the private people be able to sustain, or if they default, will my entire savings for 100 years be lost? So questions like this are naturally being raised. They are not yet answered. In fact, it has been a very, very hectic run since the budget finished. I have been trying to read up the memo. There are many things that has come out in the memo that the Honorable Finance Minister has missed out. Or it was the longest budget. We all know last year was the longest. This year was even longer than that. And despite that, there are many things which were not covered, including the change in the tax audit date and the change in the return filing date for corporates who are subject to tax audit. And our speaker on direct taxes, CA TG Suresh, one of the best speakers I can say on direct tax matters, is also my teacher. I will now formally introduce him as he takes over the stage and creates his magic about the direct tax amendments in the budget. CA TG Suresh is a graduate of Vivekananda College, is a chartered accountant, a CMA and a company secretary. He is a leading faculty in domestic taxation, international taxation, financial management, cost accounting, financial accounting for more than 30 years. He is a pioneer and role model for thousands of students, including myself, and cost and management students as well, CA students and CS students also. He is a visiting faculty for taxation at various regional councils of ICAI, be it South or other regions as well. Leading faculty sought after by all the branches of ICAI, and he is a regular faculty at the RTI Chennai, which conducts regular training for the income tax officials as well. He is an author and paper presenter. Some of his books include Simplified Approach to Direct Tax Laws, Simplified Approach to Taxation, Capital Gains Tax Law and Practice, published by LexisNexis, which is a Bible for all of us who are practicing at the income tax appellate tribunal level. We don't look beyond his book. It is an absolute Bible that we say for capital gains matters. Master Guide to Income Tax, many self-published books in finance, accounting and tax as well. He regularly contributes to various articles and news channels as well. And he has presented papers before various bodies like the CA Study Circle, Association of Chartered Accountants, Hindi Chamber of Commerce, Hindustan Chamber of Commerce, Madras Chamber of Commerce, etc. He is a member of various committees, the Direct Tax Committee formed by ICAI, and he was a co-opted member of the International Taxation Committee of ICAI, coordinator for the Diploma in International Taxation program conducted in Bangalore. He is a coordinator for the program 1 to 298 sections of the Income Tax Act conducted by our own SIRC and of course transfer pricing program as well. He is a winner of the National Award from the Capital Foundation of Society, New Delhi, from the Union Law Minister at the time. He is a co-opted member of the Committee for Members of Industry for the period 2018-19 and also a special invitee of the International Tax Committee of the ICAI. He currently holds the position as Vice Chairman of the International Fiscal Association, who are pioneers as far as international tax matters are concerned. Of course, this is only a brief profile of our beloved CA TG Suresh sir. In fact, I can say his budget sessions are one of the most well-attended programs that I have seen. His deliberation and dissection, if I should say, of the budget 3 years ago at the Hindustan Chamber of Commerce, which was conducted at Rani Seetai Hall. It was a packed hall, more than 1,000 participants. In fact, he got the memo. The memo was released late that year, the entire budget changes. And I remember before the program started, he was backstage, he was still going through all the changes. But despite that, he was able to give such a thorough and threadbare analysis. It was hugely lauded. And yes, and I am sure today also he will give us a similar threadbare analysis of the budget and the memo. This is only a brief introduction. I take great privilege and pleasure in welcoming my teacher and guru, CA TG Suresh. Please give him a huge round of applause. As a token of our love and affection, we'd like to present you the shawl, CA Suresh sir. Over to you, sir.
So, good evening, one and all. On the lighter side, Abhishek, I thought your speech will be lengthier than the Finance Minister's speech for a minute. The only problem for me is that I have to go to another program. That's a problem. So, in fact, what I thought was, given the fact that the Finance Minister keeps on breaking her own record, so the program which you referred, at that point of time, your father called me at 2:30 when even the memo and this thing was not hosted. I said, sir, give me some time, at least let me download and come. So nevertheless, as I said, it really went on well. And every time when we see the budget, especially under the current dispensation, I just want to tell every time, wow, what a budget. I think that wow, I had to wait for one more year. So, well, to be very honest with you, the only reason is, I tell you, not because of anything else. I think we should try to do something which is different from what has been done by the previous government. If we just look at this budget, don't take it otherwise. But sometimes, we have to hold on before talking few things. This budget or this finance bill proposition or directives would not have been different had the government also been different. That's the problem. We don't want that at all. We want a situation where we get something different, something where you get some path breaking. I'm not talking about the rest of the proposal. I don't understand ABC of it. In fact, I just watching the channel only at 12 o'clock to find out whether she's going to come with direct tax proposal. Didn't come. 12:30 I tried. It didn't happen. 1 o'clock, finally there is some resemblance of coming. And of course, she spoke on direct taxes. Of course, everybody started talking about it. Suddenly we all, youngsters in India, or everybody started knowing Tiruvallur now. So therefore, Tiruvallur and Kalidas, along with some small direct tax, but when you went inside, apart from the few points which my friend was mentioning about, a lot of things were there in the budget proposals which are really shocking. One of the penalty provisions which I will not discuss because I just want you to go on the lighter side. So therefore, that just looks frightening. And sometimes nowadays the section numbers, we have all possibly heard the new slab rate of tax and all. When you search in the Finance Act, new slab rate is not there at all. Then only in chapter 12 of the Income Tax Act, the most toughest question in CA examination is to be how many sub-chapters are there in chapter 12 of the Income Tax Act. And the section numbers, I think it is 115 BAC in any case. With that doubt, that's one reason why I just wanted to carry, thanks to my colleagues, all of us were just trying to go. In fact, we had 3 PowerPoint presentations to be merged. 2 of them are yet to come. I said, don't worry, I will try to manage with 1 PowerPoint. If we come, we will try to insert, merge it so that we can do. But still, we will try to do something out of the limited time available. I hope that I will live up to the reputation of what my friend said. We will do a slightly fair justice. 2 things we have to normally recommend in a budget day. 1, the finance minister should not speak for more than 45 minutes. And 2, Institute should give us at least 1 day for us to read the budget and then So I'll just broadly try to take my presentations in this 7 or 8 subjects. First we'll try to look from the perspective of an individual, which much was talked about in this particular budget. As I said, there is no change in the tax rates as such. If you go to the finance bill, you will not find any change in the tax rates. So whatever slab rate she was talking about, I think she likes arithmetical progression. So every 2.5 lakhs, 2.5 lakhs nil. Next to 2.5 lakhs, 5%. Next to 2.5 lakhs. Next to 2.5 lakhs. Next to 2.5 lakhs. Last year itself we had some pre-int surcharge. Surcharge question out. So that much number of such are there. Now next difficult question is how many slab rates are there? See, and in the process there are so many slab rates are there. That's why I decided straight away to take. So now this much amount of slab rates are there now. Now, what is that in the process you should go through? She really mentioned on a very, very brief note, you have to forego certain deductions and certain exemptions. I think she would have used a better word. You have to forego everything. As in a certain, they say, no, just see what all you have to forego. LTC. Then you should forego HRE. Then you have to forego special allowances, barring 3 or 4, which they are going to separately come out, and from the memorandum I could pick out they are going to just give the benefit for conveyance allowance for official purposes. That's one thing which is prominent. Other than that, even food coupon, the section says the food coupon of 50 rupees per meal, that they will say they will make an amendment in Rule 3.7. Once this budget is over and act is passed, they will amend Rule 3.7 to specifically say that your free meal also you will not get the benefit. That most of the software companies which get around 2,500, 3,000 rupees per month. So that is not an exemption or deduction. That is only a benefit of workers. That also the memorandum says you will not get. So of course we don't have to worry about the fourth set of people. So 1032. So that's an amazing amount of 1,500 rupees per child. That also they say you should forego. In fact, Institute recommended that 1,500 should go up by substantial amount because this amount was fixed in 93-94. They said that also you forego. That's another very interesting one. Standard deduction. See, that is very, very unfair. 50,000 rupees of standard deduction gone. Then you have a professional tax gone. Entitlement is there only for government employees, so it's not very about. Now interest under 24 for self-owned property of 2 lakhs up to 2 lakhs gone. Now just make a simple calculation. You should lose 2 lakhs, 50,000 of standard deduction. Minimum anybody will claim, because up to 1 lakh there is no need for you to give the PAN number of the landlord. So therefore minimum everybody will put an HRA rent of 8,500 rupees per month. So make your this simple calculation there, plus 80C and 80CCC plus loss in house property you cannot set off. Already there is a restriction of 2 lakhs, that also they say you should carry forward. Now if you forego all these things plus your food coupon, then you will have a arithmetical progression of 2.5 lakhs for the slab rates. Will be there. First 2.5, next 2. Easy to remember now at least. So therefore that's what they have tried. And the number, you just somehow please, my humble request, I'll share my email ID. How this results in a revenue loss of 40,000 crores. If somebody is able to explain, I'll be the most happiest person, because I tried to do, in fact 4 of us in the semester the bill, we are trying to work out mathematics, how 40,000 crores have been last year. And this seems to be a number which I think you should give a credible number. We cannot give a number just like that. 40,000 crores is going to be the benefit lost. We are just trying to work out some mathematics. Doesn't seem to be, in fact last 2 budgets I've shown, because I had some time, shown that how the statistics which is given in the budget is completely wrong, which is impossible to achieve. I think that seems to be another poor statistics which they are trying to give. I don't know, we should expect some kind of a clarification as to how this 40,000 crores is going to be lost. And it's going to be extremely difficult for them to prove this number. Already you would have seen 1,45,000 crores lost. Eventually as the financial year came to an end, you find most companies have not chosen that option. Therefore it's not going to be a loss of 1,45,000 crores as has been projected at that point of time. I think some assumptions or the number I chose it. I think we could have done. In fact, if I am the finance minister, I would have done a simple thing. Just put 2.5 lakhs, so straight away we have up to 5 lakhs, then 5 to 10 lakhs, then 10 to 20 lakhs. Make it as some relatively easy one, make the people excited. Then you say all things you forego. You cannot have 5% reduced at every 2.5 lakhs and you will not get anything. That doesn't look appealing, because you hear something and then when you just go through, that's where the disappointment comes. See, let's not try to do something for the sake of we have done something, which in effect, if you get a feeling that you have not done, that's where the disappointment comes. At least you don't do, no problem at all. Absolutely no issues. Yes, we know that the government has got a constraint, there's no problem. We all know that there's a fiscal deficit problem, everything is there. But I think we could have done something different, either something sensational or don't do it. The small tinkering, so I feel is something which is not in the best of the things you can do when everybody is expecting you to get something out of this budget at the personal level. So apart from this, just look at if you are a businessman choosing under this scheme. So to also additionally, apart from whatever mentioned, you should lose 10 AA, you should lose your additional depreciation, you should not claim investment allowance, you should not claim scientific research expenditure, you should not claim 35 AD or 35 CCC. So if you are a business person, if you are also willing to forego, you can also do this section. And the best part of the section is how do you exercise this option. So whenever we listen to the word simplification, we generally get excited. That's where we find the law becomes more complicated. So if you are not having business income, this provision you can exercise optionally every year. You can choose, this year you can choose. But let's for a moment assume if you are having a business income, you have to exercise option in this section, and once you exercise the option, you cannot go out of this. You have to continue with this option forever. If you are a business having business income and wants to choose this section. And they also say that this option has to be exercised at the time of filing of return. Every year under 139 if you are not getting business income. And if you are having business income, from assessment at 21-22 or any year, you choose once. That's all. Once you choose, you are never allowed to go out of the section. That's what the section clarifies. So if you are an individual having no business income, along with the written off income to furnish, that of course you can every year you can specify whether you want to come in this section or not. So in any other case, on or before due date, and starting from 21-22, and once you do it, you can never go back. So that is the extent of this particular provision. Look at, for the sake of just the complexity, I can either go there or go there. As a company I have options, as an individual I have options. And we are looking at a situation where we want to simplify the law. And I just leave it to the brains here as to whether the law is in effect being simplified or not. The second point which I will move to is the amendment in section 6 of the Income Tax Act. Of course, obviously these proposals are surely seem to have been taken from the recommendations of the Direct Tax Committee. You could know that it's not been brought in or not in this thing. From the face of it, it appears, because already you would have seen some leakages have come from various sources about the residential status has to be plugged. By the way of amendment, I can surely say this is the repercussions of the Direct Tax Committee recommendations which are tried to incorporate in the current proposal itself. Now at present, to become a resident of India, so you should stay in India for 182 days or 60 or more in the previous year and 365 the preceding 4 previous years. The second condition of 60 days in certain cases is going to be replaced with 182 days. So it's earlier 150 and then they 90, then it made to 150, then they made to 182. The objective of increasing that from 60 eventually to 182 days. For that we need a lot of foreign exchange inflow. That's what the government said. So we want more foreign currency to come to India, so we should encourage Indians to come to visit India. Thereby our foreign exchange position improves. Today that situation is not a problem for us. We have a comfortable foreign exchange reserves. And also the things have changed dramatically in terms of people avoiding tax by planning. That's what the memorandum says. So the 60 days in certain circumstances by virtue of the explanation is replaced with 182 days. That is, if you leave India as an Indian citizen for employment purposes, and if you leave India as a member of a crew of an Indian ship, or if you are an Indian citizen or person of origin residing outside India, if you come on a visit to India. So in these 3 circumstances, the 60 days shall be substituted by 182 days. Now what you should understand, what is the impact of this provision? The impact of the provision is, the first condition is 182. Now if you satisfy the first condition, you are not going to see the second condition because you need to satisfy only one condition to become resident. Now if I change the second condition 60 to 182, so if I satisfy first, I don't have to see the second. If I don't satisfy the first, it is impossible for me to satisfy the second condition. Because first part of it is 182. Since the first is 182, if I don't satisfy one, nowhere I'm going to satisfy 2. Therefore the implications or the effectiveness of this provision, the second condition is not going to be applicable in 3 situations. If I go out of India for employment, if I come on a visit to India, or if I go out of India as a member of a crew of an Indian ship. So what they have done here, they have not changed for all the 3, but in the third category, that is if you are a visiting Indian citizen or a person of Indian origin, if you come on a visit to India, that 182 is now going to be replaced with 120. So therefore, if you are in India for 120 days plus 365 days, so then it is possible for you to become a resident on the basis of applying this second condition. That means if your son or a daughter is residing outside India, if you are residing in US, they can come to India earlier for a period of 181 days and still remain as a non-resident. It is also possible for them to come in the second half of the previous year, say on 3rd of October or 4th of, they should not come on 3rd October in this financial year because it's a leap year. So if they come on 3rd of October and stay up to 28th September of the next year, effectively they can stay in India for 362 days and still remain as non-resident in India. And it is also possible for them to become a non-resident by virtue of the application of similar section in some other country, also be a non-resident. So this is what the government says we want to plug. Because there are circumstances where people are trying to plan on the basis of visit, they don't become resident in any country. So therefore, in the case of visiting Indian citizen, 182 has been now replaced with 120. That means 182 in the previous year or 120 in the previous year plus 365 in the preceding 4 previous years. So which is a very significant amendment. Along with, they are also introduced one, this was the amendment you're talking about. For Indian citizen or person of Indian origin residing outside India, if they come on a visit to India, so they reduce that number of days to 120, that is read it as 182 rather than 180, so 180 to 120. That means second condition effectively becomes applicable for visiting Indian citizens. Besides, there is a very interesting amendment or a new section they introduced, section 1A. So if you are a citizen of India and you shall be deemed to be resident in India any previous year, it is not liable to tax in any other country or territory by reason of his domicile or residence or any other criteria of similar nature. So this is a very interesting point. If you are a citizen and if you are not liable to tax in any other country, so then in India you will be deemed as a resident. You don't have to go by the number of days and all. If an Indian citizen not paying tax in any country, that means if you are trying to domicile in a tax haven, in a place where you don't pay tax, in India, you will be considered as a resident. So this, of course, as I said, is based on the recommendations in the direct tax code. Besides, they also altered the concept of R&R. Now, at present, you will become a resident and not non-resident if you satisfy any one of these two conditions. So, non-resident in at least 9 out of 10 preceding previous years, and you have stayed in India for 729 or less in the preceding 7 years. You satisfy one of them, then you become a R&R. So what they have done is, they have dispensed with the second condition. Second condition has been removed now. That there is no more stay in India for 720 or less. And the only thing is that in the first condition, they have given a slight leewage. Instead of non-resident in 9 out of 10, they want you to be non-resident in only 7 out of 10. But the second condition has been dispensed with. That means to become R&R, today you have only one option alone. You have to be non-resident in 7 out of 10. If you are not going to be non-resident 7 out of 10, you automatically become R&R. So R&R, that means you are going to be supposed to tax on the global income. I think India is a very, very few country with this concept of NOR, primarily because these provisions are there from 1922 Act. So they continued in the 1961 Act. The only thing is that up to assessment of 2003-4, I had to be non-resident only in 2 out of 10. So they just gave a huge opportunity of tax planning. Only assessment of 4 or 5 became 9 out of 10. So we have moved to the next stage. Maybe a couple of years down the line, I don't think we will even have this condition also. But slowly but surely, the concept of NOR is going to disappear in the law. In fact, it's already been attempted earlier when Yashwant Sinha was finance minister, but it has to be rolled back. But now, once again, they are trying to slowly push the gun to just remove the concept of NOR. One step done, maybe in few years' time, even this will also go up. These are some very, very significant amendments just made in the resident status, which we have to be extremely careful about. So the section, in fact, there are a lot of pre-budget rumors that tax audit will go. So will it go? So those kind of questions, a lot of people are raising this particular point. Though we did not go as such, but there was some very significant change were made in clause A. So now the turnover limit at present in clause A is 1 crore. They have not changed to 2 crores. Even after 44 AD went up to 2 crores. So only thing is that in the proviso to 44AB, they specify that if your turnover is between 1 to 2 crores and if you opted for presumptive income under 4480, then 44AB will not apply. So what they've done now is 1 crore, they have increased to 5 crores. And of course in the last few years, definitely we know that from 2016, in India cash is a very bad word. It's one of the very, very bad words. So therefore it continues in this section also. Very surprisingly here if you look at, there are two conditions you have to satisfy. So one is aggregate of all amounts received including amount received for sales, turnover, gross receipts during the previous year in cash does not exceed 5% of the said amount. So aggregate of all amounts received including amount received for sales, turnover or gross receipt during the previous year in cash does not exceed 5%. Aggregate of all payments made including amount incurred for expenditure in cash, so during the previous year does not exceed 5% of the payment. You can see some changes they will try to make before the bill becomes passes as an act. Now what is that they are doing? Assuming for a moment I follow mercantile base of accounting. Now here aggregate of all amounts received including amount received for sales turnover does not exceed 5% of said amount. And that area where I am still confused. All amounts received including amount received for turnover of gross receipts. The section itself, its applicability is going to be based on the turnover. So therefore, I don't know what they are trying to mean by all amounts received including amount received for sales.
All amount means loans, etc.
No, the point is, we have consistently right from 80 HSC to 10 AA. The numerator denominator has to be same. You cannot have in the numerator something other than turnover also. Denominator you can have something else. So your tax audit is based on the turnover.
The cash receipt is 10%.
No, the only point is that I'll just come back with a few thoughts which I'm trying to say. That which possibly this there would have been a last minute insertion. They will change before the act. Now what in this particular case are they tracking only about receipt or the total sales as such? What will happen if it is outstanding as on 31st of March? And I receive the sales after 31st of March, because beneath the section it says turnover or gross is during the previous year. Now should I have to take only the sales received during the year along with the sales in cash, or what is that they are trying to intend here? Because you would have seen in original 44 AD when they have changed the 8% to 6%, that 6% will be applicable, but subsequently when it became an act, when they introduced the section, they gave time till 139 one due date. So here total of receipts in cash should not exceed 5%, total of your cash payment should not exceed 5%. But when you are trying to introduce these kind of sections, this is really going to pose quite a lot of challenges because of the fact that if I follow mercantile system of accounting, so what is that they are trying to say? So we need some clarification on this particular point. So right now, I've just simply reproduced what is there. So all amounts received, including sales received, does not exceed 5% of the said amount. Said amount of what? What is the equation? So at least in expenditure seem to be clear. Aggregate of all payments, including the amount incurred for expenditure and cash, does not exceed 5% of said payment. So I think they should have kept a little bit more simpler. Turnover 5% allowed in cash. Our total expenditure 5% allowed in cash. Maybe that would have been a lot more simpler. I don't know. There seems to be some kind of what they're trying to intend, why they want to intend. Maybe should they have, maybe they would have considered tax audit and maybe institute would have taken up the issue. Therefore, they don't want to leave the tax audit. We don't know. So whatever be the case, the introduction as on this format looks very interesting, and we need some more clarification from them. Now, corresponding the question which arises now, assuming for a moment I satisfy this question, all my turnover is only in check, and my turnover is 4.5 crores. Whether the tedious provisions will it apply for me? So, will I be subject? Because individual and HUF, our colloquial version of reading this section will be, unless you are subject to tax audit, the tedious provisions will not apply. This is the normal understanding of most of us. But when you go to fine prints of 194C or J or H or I, 194C is completely differently worded. 194C says you must be subject to audit under clause A or clause B. If you read 194I, H or J, they don't talk about you should be subject to tax audit. It only says your monetary limits mentioned in clause A and clause B should be exceeding that. So if in the preceding financial year, if your monetary limits mentioned in clause A and clause B should have exceeded. Oh, therefore suddenly they found there is going to be a problem here. Because assuming I satisfy this, for the tedious purposes, 5 crores becomes a limit. The last thing they want is to lose the tedious revenue. So what they have done interestingly, across sections in tedious, for individual HUF, they made a very interesting change. They don't mention today clause A or clause B of 44AB. Instead, in all the sections of tedious provisions for individual and HUF, they specify the amount today. If your turnover in the preceding financial year exceeds 1 crore, or if your professional gross wages exceed 50 lakhs, then you should be subject to TDS. That means today the sections do not make a mention about 44AB at all. They straight away replace the erstwhile number of 44AB, which is 1 crore and 50 lakhs. That means even if you are not subject to tax audit, if your turnover in the preceding financial year exceeds 1 crore or 50 lakhs in the case of profession, TDS provisions will apply from 1st April 2020. So therefore there was a bit of an anomaly in the law. C was saying you must be subject to tax audit in the clause A or clause B. Other section was saying you should cross monetary limits, whether you are subject to tax audit or not, this section will apply. But across all sections of TDS, no mention about 44AB at all. Financial year 1920, is your turnover crossed 1 crore? Yes, TDS will apply. If your gross receipts exceed 50 lakhs, TDS provisions will apply. That's a very interesting change. Very interestingly, today morning there was a session I was handling. I was mentioning about this conflict. In fact, somebody even asking me, did you recommend this and whether the change has happened on account of this? I have nothing to do with it, but I was very surprised to find that interestingly, they changed this lacuna in the law when they changed 44AB turnover limit. There's 80EA, somehow this section the government feels, every government, in fact this section was introduced every 2 years for a long time. Every 2 years this 80EA comes, of course last year it was introduced, and somehow the government still seems to have the opinion that 80EA already develops a lot of real estate purchases. If that be the case, I don't think that sector will be in trouble. Again, another non-Kiva section, the section was extended by 1 more year to 31st March 2021. Just look at some kind of illogic here. On one side, you want people to forego all deductions and then go for a move to a different lower rate. If that be the case, this section which has got such a limited utility, how many of you would have used this section? I leave it to you. For assessment in 1920, you would have filed the tax returns. And why there is a necessity for increase? At least this section is already dead. Let it come, let it die. There is no need to revive a section when your policy is to remove deductions. In fact, she gave us statistics. I saw out of 100 plus exemptions, 70 have eliminated. Then why this one? We would have as well eliminated. Already the section is dying. There is no need to revive the section. There seems to be no logic in this particular section continuing, but still, I don't think it's seriously worth talking about the section. Therefore, we'll skip to the next one. Filing of return, as my friend was already talking about, maybe like the tax audit due date they have extended to 31st of October. I don't know what is the message they're trying to give. Don't come and ask for 1 month extension because already given it right in the beginning itself. So then there's a very interesting point. So earlier this section, in this particular clause, companies, persons who are liable to audit and working partner of firm whose accounts are required to be audited under 44AB. The underlying logic which I thought was, normally the working partner will be entitled to a remuneration. The remuneration is taxable in the hands of partner 28.5 if it is allowed as deduction in the hands of the firm under 40B. 40B book profit calculation you cannot collect without arriving at the income of the firm because first 3 lakhs 90%, balance 60%. Therefore, without arriving at the income of the firm, you cannot arrive at the income of the partner. If the firm has a due date of 31st of October as per the revised one, the partner cannot have a due date of 31st of July. So that's one reason why the working partner provision section, though the section does not use the word working partner getting remuneration. In fact, some of you can be aware of this particular point. When this point was not there, there's a board circular. The board circular used to say a working partner who is entitled to a fixed remuneration will have 31st of July. And if working partner is not entitled to remuneration, the due date will be only 31st of July. That means only if you are a working partner subject to 40B calculations, then only you do it on the 30th. That was circular. When it brought as a part of an act, they only use the word working partner. Just for a moment assume, if some of you join my firm on 31st March 2020 as a working partner, since my firm is subject tax audit, whether you are getting remuneration, you will not get any remuneration joined on 31st March, right? You will get only from 1st of April. But still, because you are joined on 31st March, your due date would have become 31st of October. That's a very simple planning to do. Instead of asking for extension differently, this is a simple way of getting extension. But what they have done, they removed the working day. Now today the section uses the word only partner. I feel this is also pretty logical because the remuneration, earlier logic seems to be wrong. Because apart from remuneration, interest is there. Apart from it, share of profit is there. Those information also I should disclose in the return. If I don't finalize my firm's return, assuming for a moment I don't get remuneration, but still in my returns I have to show what are the incomes exempt from tax, right? I have to show the share of profit exempt from tax in the 10(2)(a) in my return. But how can I show it on 31st of July when my firm's due date is 31st of October? I think finally they have understood this particular part. Therefore this section today removes the word working in the section. It only uses the word partner. So that means all partners, if their firm is subject to tax audit, will get the due date of the firm. That means whether I am a working partner or not, the due date of a partnership firm, if it is 31st of October, the partner's due date, whether they are working or not, will become 31st of October. Very good amendment. It's a small amendment. I think definitely this is something which we can watch, a good understanding of how the returns work. So there is another interesting amendment in section 140. So verification of returns, earlier signature, now it's verification because most of our registered signatures are not with us. So hopefully that we have to keep it protected. So therefore today you have to only verify the returns. Now apart from director and apart from the firm, the section says any other person may be prescribed. So we have to wait and see whom they are going to prescribe for verifying the returns. So therefore apart from directors or the partners, 140 allows any other person, that may be prescribed in future, they can verify. The digital signature of them can be also used. That's one. And of course the concept of faceless assessments, which is again another talk for the last 2-3 years. So right now that is available only for the scrutiny assessment, and this particular proposal extends that with the best judgment assessment also. So best judgment assessment will be faceless. So if you fail to satisfy the conditions of 144, I think definitely they can give you opportunity faceless and then do the assessment. That's the facility. And they are also trying to extend this concept to CAT appeals also. So therefore they have introduced one section, a similar scheme. So will be also for the first appellate authority. Possibly, in fact I was jokingly telling in the class last week when I took this portion, I said the sections 143, 3A, 3B, 3C were all saying the scheme has to be placed before the parliament by 31st March 2020. Just telling them, don't worry, 100% you can be rest assured. This particular budget will extend it to 31st March 2021. The finance minister may be wrong. She said 31st March 2022. So therefore, the scheme is going to be placed before the parliament before 31st March 2022. Same thing they are also saying for CAT appeals. The scheme will come, it will be notified and placed before the parliament for 31st March 2022. So 2 years window for them to place the complete scheme. So we'll have 6th stage of phase plus 1, and then of course we will have, so why that? small disclaimer before I start this slide. I'm now like a finance minister now, because most of the time the finance minister reads out the budget speech prepared by somebody else. So that's a so two of my office colleagues have prepared this. So I'm not sure. I've not read the content. So therefore, reading along with you this content, though of course, like a robo, I've already gone through all these proposals. In fact, Abhishek was full of praise for this particular abolition of this particular tax, which is going to have a huge bearing, not for Indian citizens in my view. It's going to be a huge benefit definitely for outside India people. And the 25,000 crores, the number which is given, the 25,000 crores of number, how it is possible from the point of view of Indian residents, you see. ATL is also not reintroduced. At least most of you will be aware of. There was a 15,000 reduction available for dividends under ATL. That was not there. Earlier, those who are used to scheme, just to recollect, up to 31st of May 1997, dividends were taxable only in the hands of shareholders. From 1/6/1997 to 31st March 2002, dividends were exempt from tax. 4 out of the 5 years in that period, the finance minister was same. On 1/4/2002, you just go and listen to his budget speech. So the finance minister said, I don't understand the current system of tax. I am moving back to dividends taxable in the hands of shareholders because equity is not there when the dividend distribution tax is there. But 4 out of the 5 years he was the finance minister. That's an interesting point. He said, if the dividends are taxed at the rate of 15%, let's assume for a moment the slab rate is going to be 0 to 30. Who's going to get the benefit? The benefit is going to be there only for the high income people. Assuming I come under the 5% tax bracket, I will not get the benefit if the dividend distribution tax by 15. But if I am at the high slab rate, instead of 15% tax, I will be subject to 30% tax. Therefore, I am reintroducing the concept of taxing the dividends in the shareholder. It existed only for one assessment year 3-4. Again from assessment of 4-5, we are back to 115.0, dividend distribution tax. So this is something very interesting. And then, right from 2015, the dividend distribution tax was tinkered on various bases on the same point. First, grossing up was done for levying dividend distribution tax. The reason given was, earlier the dividend was between 0 to 30%, therefore I bring equity by grossing up. Then they came out with another interesting point. They said we'll also have a 10% tax in excess of dividend of 10 lakhs. You need the reason. The reason is same. Because earlier dividends were taxed in the hands of shareholder. Today we have a dividend distribution tax. To bring equity, we are taxing 10%. Now finally, actually the finance minister was hinting that who brought the dividend distribution tax? You only brought it, therefore it's time to tax. Everything is fine. Now we have just removed this particular tax. How there is going to be a loss of 25,000 crores of tax? The only possibility is the foreigners are not in a position to claim the double taxation relief under the current regime of DDT. I don't think, you look at the provisions of 57, you don't have an ATL reintroduced. We don't have section 57, possibly you will be aware of. Once the dividends are taxable, then you are entitled to claim the expenses incurred in respect of the same. Now 57 very clearly provides you will get only one deduction for dividends now, which is interest, but that too subject to a maximum of 20% of your dividends. Suppose if my dividends is 1 lakh, I can claim only 20,000 of reduction of interest, no other reduction is available. So just for a moment understand, if I am earning a dividend income of 1 lakh, if I borrowed investing the shares, and if I am not borrowed, you are always entitled to disallow. Now when I have legitimately incurred certain expenditure for investment in shares, why that deduction has got to be restricted to 20%? Now with no ATL, with no full deduction for your purchase of shares, and now look at the tax rate. I don't tell you, the tax rates are 42%. If Azim Premji is going to get the dividends, it's going to be taxable in the next year. Now he is going to pay tax at 42% plus, given the surcharge which we have. And therefore there is no way the scrapping of dividend distribution tax and shifting the tax in the hands of the shareholder is nowhere going to make the government lose the revenue. That estimated amount of loss with the error debt should be predominantly on account of double taxation relief that's going to be claimed by the investors from outside India with the invest. I don't think it is not because of us. And if at all loss of revenue. So I think those point of reintroduction of dividend tax, I'm not having this point. That one you say DDT is best, then you say tax and transfer shareholders is best. Again you go back to DDT, again you just go back to the shareholders with lot of riders in the process and giving some number. If when you are having so much of a revenue problem, I am not able to understand why you want to forego 25,000 of crores of tax today for a corporate. Not required at all. So therefore, you divided, but don't give some numbers. They should have given some simple points. ATL for 15,000 has to be restored because of the fact that it's a benefit small investors had. Time immemorial, we would have read ATL. Secondly, there is no need for you to restrict. So again, 184 has also come back. Only thing is that earlier it was 2,500, 5,000 rupees of TDS. Just look at the amount of complaints which is going to be there for many companies. They're going to give a dividends. If I'm going to have a 10,000 shareholders, today I have to go through 184 because the traditions of TDS will apply if it crosses 5,000. There's going to be a huge complaints and the loss of revenue in my view, nothing to do with us. Nevertheless, they've gone to the system, so whereby this 194 comes back, dividend distribution tax abolished, and the restriction on deductions are some of the major changes were done as far as this particular section is concerned. So I'll just skip this particular section on account of the e-commerce operators being brought under TDS on account of the time factor. I'll just skip this one. This was a point which I was talking about. All the sections of 184C, H, I, J, they are now specifying the amount and they are not linking with 44 AB as such. So startups, of course, two changes are made in ATIAC. The turnover limit has been changed from 25 crores to 100 crores, and instead of 3 out of 7 years, you can choose 3 out of 10 years. This is also not without any share of controversy. Earlier, up to 25 crores is my limit. Now today the limit has been increased to 100 crores, and this provision has been made effective only from the current assessments made in prospective. Now, assuming for a moment I've already started in 2016, because you will be aware of the sections available if I start in 2016. If my turnover at that point of time is 30 crores, I will not be eligible. Now, because this amendment has moved to 100 crores, can I take this particular amendment as retroactive and then take it? In my view, it is definitely possible because of the fact this is a beneficial provision intended for the purpose of benefit of startups, which is the Prime Minister's pet project, and therefore, so there can be some thought process that can we apply this for the preceding previous also, given the turnover has now been changed from 25 to 100 crores. So an attempt can be made to find out whether this can be applied for earlier years also. So again, the startups ESOP, very good provision, though I'd have loved this to be extended to all ESOPs. Because right now we'll be aware of ESOPs are taxable at the time of salary as a perquisite and also at the time of capital gains. Very few countries in the world tax the ESOP at the time of perquisite because you don't realize the cash. So therefore, at least a good beginning is made. So here, so the tax on ESOP at a perquisite level for startups, ESOPs have been dispensed with, and you have to pay the tax only after the expiry of 48 months or 4 years, or unless you make the sale before that. It's a very good amendment, but exclusively applicable only for eligible startups only. So definitely, if it is, should be extended to all ESOPs, considering the global practices we have. So this certainly the memorandum says a lot of times it found some fake entry, fake GST, improved credits and all been claimed. So therefore, what it says that we should have something in the Income Tax Act to prevent this. So suppose if there is a false entry or an omission of entry relevant for income computation to evade tax liability, so the AO may direct penalty of some equal to the aggregate amount of such false entry or omission. So a lot of times you may not be aware this purchases is a bogus purchases. You may not be aware. So in those circumstances, what it says is that if it is established that it is a false entry or a wrong entry, then 271 AAD allows you to a penalty equivalent to that of the amount of such false entry. The memorandum has got a fair justification for this particular point. So they said there is a huge amount of GST input tax credit claim racket was going on. A lot of fake entries, fake invoices, people not having business doing it. So we also want to use the Income Tax Act to prevent this malpractice. Therefore, that is the reason given for this amendment. So that is something which I thought I can bring it to your notice. So again, the scope of the TCS has been extended. So possibly this LRS scheme, to be aware of, a lot of investments are being made through the LRS scheme. So they are just trying to regulate this. One more way of regulating, if you are going to send under LRS scheme beyond 7.5 lakhs, there should be a TCS provisions are made applicable. So it's a very small amount. Similarly, next time when you want to book a foreign tour package, so if you want to go through some SOTC or Cox and Kings, I think they will have to now collect the TCS irrespective of the amount. And the package says it will include for your sightseeing outside India, hotel stay, all put together, the TCS has to be collected. And another important point, right now purchase of goods is not coming under TDS under 194C. That means sale is not coming under TDS. So therefore they are now trying to bring the sale within the ambit of TCS. So that means if you are going to make a turnover of 50 lakhs from one person, then there is a requirement to have a TCS at the rate of 0.1% unless that person produces, if it doesn't produce Aadhaar number or PAN number, the 0.1% is further going to be enhanced to 10 times of the amount of tax. According to the memorandum, these are all intended to widen the tax base. So very interesting provisions. It's going to be effective very short from 1/4/2020. Purchase of 50 lakhs of sales, which is currently not under 184C. So will be subject to a withholding tax burden. We go for a TCS route. So therefore the 206C suddenly becomes a very, very important provision which most of us would not have cared about this for the time being. It's going to take a lot of precedence from 1st April 2020. So, couple of other provisions I will touch base, and then so permit me to leave because I have to be there at another place another 10 minutes time. So currently PF up to 12% is exempt from tax. Contribution to superannuation fund 1.5 lakhs. Similarly, contribution to NPS. So they just created one very interesting provision. If the contribution to superannuation fund, NPS and Provident Fund, if it is going to exceed 7.5 lakhs, then they say that amount will be taxable. So, assuming my basic salary is 10 lakhs, 12% of this I can contribute, there is a restriction, unlimited amount can also be contributed. So, if I contribute 12%, my employer contributes 12% of 1,20,000 per month into 12, it becomes 14,40,000. So, what the government says, so up to 12% exempt from tax, therefore you are using it. So this helps the high net worth individuals to avoid the tax, because currently we are in exempt regime. So therefore if your PF plus NPS plus the contribution towards the superannuation fund, if it's going to exceed 7.5 lakhs, then the excess amount will become taxable. That means the total contribution comes to 10 lakhs. 2,50,000 is going to be taxed. Not only that, the interest on the excess amount is also going to be taxed. So this is a very interesting provision, and the reason given by the government for this, so there should be equity brought between a high net worth individuals and others. So people under the lower bracket never get such an opportunity, because so therefore we want to tax, because the people are misusing the EEE regime of exempt tax. So 50C, 43CA, 56 to 10. So whenever any finance minister talks about this, just jump in the air and then suddenly it comes out again. Because when Mr. Arun Jaitley introduced a similar provision assessment in 1920, he also started in the same lines. Currently, both buyer and seller are taxed under 56(2) as well as 50C. Therefore, we thought they are going to come out with a proposal that one of them will go. So when Arun Jaitley introduced the proposal, he said, therefore we give 5% variation can be given. Maybe if my budget speech at that point of time, I said this 5% has to be at least made as 15%, because 50C replaced a chapter called chapter 20C. where the Supreme Court held in CB Gautam that a 15% variation should be accepted. I said once a government does a variation, the variation has to be 15% because that makes a lot of logic because you borrow from a Supreme Court judgment to introduce. But at that point of time only 5% are introduced. So again the finance minister started with this particular point. But I thought she is going to scrap 56 to 10. But by the time we thought, she said the circle rate difference will be increased from 5% to 10%. So that means the stamp valuation actual consideration difference as against 5% earlier across the three sections of 43CA, 56, 210 and 50C. From 5% the deviation has been increased to 10%. Suppose my stamp valuation is 50 lakhs, my actual consideration is say 52 lakhs. So 10% variation still is there, therefore no 50C will apply. That is the point they are trying to come back and say. So again for the benefit of those in the international tax as such, and currently if I have interest income, there is no need to file the tax returns in the 115A if tax has been deducted as source. This provision is not available for royalty in FTS because those come under 115A 1B. So what they have done is they have extended the non-filing of return to royalty and FTS also. Consequent to the introduction of taxability on mutual fund income and dividend income, 194 and 194K make a comeback. So that's it from my side. Thank you very much for your patient hearing. So thanks again the Institute for giving me an opportunity.
Thank you so much for such a threadbare and thoroughfare analysis, T.G. Suresh sir, in such a short duration. As a token of our love and affection, we'd like to present him with a small memento from the CA Institute. We will next move on to our next speaker, Advocate K. Vaidishwaran sir, who will be covering the indirect tax and GST aspects of this budget. Even though GST per se, there was not many changes introduced in this budget, I'm sure many people will be eager to hear his inputs, especially given how late we were all waiting last night. That last minute one announcement came, extended by 3 days. But despite that, today 7-8 hours the website was down in the morning. So whether they will extend again by 7-8 hours, we don't know. So we can always take sir's inputs because he's such an expert in all these matters and anything concerning indirect tax and GST. So I will now formally introduce our next speaker, K. Vaidishwaran, advocate and tax consultant, obtained a law degree from the Madras Law College and enrolled as an advocate in the year 1990. He is also a grad CWA, cost and works accountant member that is, and has completed his ACS from the Institute of Company Secretary of India. He joined the offices of Subrayar, Padmanabhan and Ramamani Associates in the year 1990 and became a partner in 1998. He started his own firm in 2000 and currently operates in Chennai, Bangalore and New Delhi. He has more than 30 years of experience in advisory capacity as well as through appearance before appellate authorities, appellate tribunals, courts and various appellate authorities and regulatory authorities pertaining to domestic, international tax, excise, customs, service tax, VAT, CST, GST, FEMA, RERA and company law as well. He is considered as a specialist in tax and legal matters with in-depth knowledge of the business and tax laws. He has addressed more than hundreds of seminars, I'd say thousands actually, conferences on law and taxation across the country and abroad as well. He is one of the most sought after legal professionals in GST and business restructuring matters. He advised clients across the country on various verticals and various sectors as well, and he is advising various associations and Chamber of Commerce also. He wrote the first comprehensive book, VAT in India, when VAT was introduced in 2005, and has also authored books on SENVAT credit, books for students appearing in the CA final examination, and has written hundreds of articles covering various issues pertaining to tax, GST, corporate law, constitutional laws as well. He has just completed his books on taxation of the digital economy, covering international tax and indirect tax aspects as well, which is expected to be released soon. He is the chairman of the expert committee of GST and Madras Chamber of Commerce and Industry, and also a member of the General Committee of Madras Chamber. He is a member of the Finance and Taxation Committee CII, Vice President of the Revenue Bar Association, member of the SIC Indo-American Chamber of Commerce, a recipient of the Vocational Excellence Award from the Rotary Club of Madras, and actively involved in various social causes through music and also forays into humor writing. He is a speaker with a lot of flair. He is not someone who is new to us at the CA Institute. We all affectionately enjoy his speeches, and thank you so much, sir, for taking time out of your busy schedule to be here with us. With this, I'd like to honor our Vaidishwaran sir with a shawl before I will come to the dais. With this brief introduction, I request Vaidhi. Thank you.
Thank you, Abhishek, and good evening, friends. I've been doing this exercise of coming on the budget evening for the last many years, and the numbers are dwindling from last year. Normally there won't be any space at all. People will be completely standing across each person's legs also. Probably the reason is obvious. The social media is much more powerful, and as and when the budget unfolds, you get every aspect of the budget through messages, and by the time you come to the meeting, you are actually aware of the budget itself. The speaker is not going to give you any fresh inputs. But there were points of time when you felt that the speaker would have read and come across, and we also tried to live up to that expectation by giving some tidbits here and there. Well, it's been a long day. I'm still tired after listening to Madam. I was in a television panel before the budget, as pre-budget, and we rolled out some kind of expectations as to what is going to happen. Some of them have come true. Luckily, some of them have not come true. And then went to Madras Chamber to view the budget and give our reports to the press. The speech was never ending. And each sentence was repeated thrice. Doesn't mean that you will get deduction thrice. First itself is not there. There is a question of thrice. As TGS pointed out, saying that you will not get anything if you go for the option, and he's amazed by this 40,000 crores numbers. He's a very calm person. He gets amazed by all these things. These are all routine. If you regularly watch budget speeches, some fancy numbers will be thrown across, and it's up to you to accept it, discount it in whatever way it wants. So, if you look at some of the, I'll just touch a few from what he talked about and then move to indirect taxes. One is that there are some, I would say part B of the budget was brilliant. While part A drove on for a long time, part B was brilliant because for years we've been talking about dividend distribution tax getting abolished. See, it's not the question of who's getting the relief, whether Indian shareholders get the relief or foreign shareholders get the relief. It is a systemic error which had to be rectified. You cannot have profits of an organization taxed, and then you cannot have the dividend that is distributed taxed, and then you cannot again have a 10 lakh limit and then say I will again tax it. It's a triple taxation. It was screaming for reform. And every year, everybody asked for this abolition of DDT, and finally, you got that happening. Now you must understand why it has happened. 15% is going to be your effective tax rate for a company which is newly formed. And imagine a scenario where you are able to create an entity with a 15% tax rate and there is no DDT. India will become the most attractive tax destination in the world. That is the story behind. You have to read behind. Unfortunately, it's not well packaged. It's again a problem of how we project it. We are looking at China-US war, trade war or disputes or whatever. You're looking at Chinese entities in Chinese walking out of China because of employment cost increase and other factors. And now, of course, the virus factor and so many other health reasons. These companies are looking out to set up another base, and you have competitors like Philippines and Vietnam and Cambodia and Bangladesh competing for this market with attractive tax rates. So it is today a rate of tax war in direct tax. What Pondicherry used to do, India is now doing. Those of you who are senior will know Pondicherry sales tax. You'll go to Pondicherry and buy a car and come because it is cheaper there. Okay. So India is now looking at that and getting at that space, and that is precisely why you are getting this DDT apart. Because what all people did to get out of DDT, they did this complex buyback, they did this transaction, that and everything was DDT. So you get rid of this tax of DDT, you will have a massive flow happening, is my expectation, provided they do it well. They will do it because that is very clearly the agenda. The second aspect of the direct tax is the playing around with the significant economic presence. Since I just now finished the book on digital economy, some of the amendments are echoing some of the thoughts which I had. But it is yet to take shape because countries are not able to agree on this, and therefore we will have unilateral action. Each country will try to do something. That is why India is trying to do an amendment. At least they are focusing on 1422 to ensure that some kind of discussions happen. As far as your amendments with reference to rate of tax is concerned in terms of individuals, etc., this is an old game. 2.5 becomes 5 lakhs, but it's not really 5 lakhs. If you calculate all the rebates and calculations, right, it will be 5 lakhs. So all of us would spend calculation, etc., and then WhatsApp messages on how it is 5 lakhs. Same drama, option, not option, option not being available. But let's look at the governments. They had very little headroom. You could not have completely given off some major relief from an individual perspective because you didn't have money. Tax collections were dismal. Revenue is dismal because growth was dismal. So you can't obviously get that money from somewhere. It can't magically come. The dispute resolution scheme will give money. But that is obviously not their part of the finance, but it will come later. The dispute resolution scheme will give money because the indirect tax scheme gave them 38,000 crores. And the 2016 dispute resolution scheme of income tax failed because they also ask you to pay penalty and interest. A portion of interest and a portion of penalty. Whereas what the FM said was, in the new dispute resolution scheme, you have to see the broad contours of the scheme, you pay the tax, interest and penalty will stand waived. And that's a big relief because if you take 234BC interest, it is much more than the tax. And all disputes are pending over many years. So the accumulation would have happened. And some Supreme Court would have already come saying your matter is taxable. So ideally I am expecting this scheme to be a roaring success, and that is probably why they also talk about a very small window, etc. to close it. Only challenge is whether you will have money to pay under the scheme. Because whatever money you had, you pay under the Sabka Vishwas scheme and close that matter. So how do you get this money to pay under the scheme can be a good question. Now coming to the indirect tax proposals. Not much of talked about it except because I think she suffered certain health issues as she progressed towards the end. I think it was low sugar or something which she went through. It was unfortunate. But when she talked about that, that was the topic was health cess. Ironically, it was health cess when she was talking about it. Health cess is a separate levy. Over and above all the customs duties, over and above all the duties of custom that is levied, on value at the rate of 5% on certain listed items, and the listed items are all medical devices. So right from your ECG to your stethoscope to your X-ray to your apparatus to your artificial teeth to your artificial joints to every aspect of medical equipment or medical technical equipment that is used in health business is now getting an additional 5% health cess. And obviously the intention is that if you buy it domestically, you will not have it to discourage the imports. In reality, it won't happen. Reality is that you look at quality, you look at agreements, and you look at servicing, etc., and still buy an import. And health cess is a cost, so you will accumulate the cost. Anyway, hospitals are not liable to GST, therefore they can't take the credit. So this will just accumulate as a cost as far as the business is concerned. Coming to some of the other aspects of customs duty in terms of rate. FM made a statement saying that we have looked at all exemptions, we have reviewed all exemptions, and we have rationalized wherever possible, and we'll rationalize again. In effect, what has happened is significant across the board. I'm just giving you some items. Butter, ghee, butter oil 30 to 40%, cheese 30 to 40%, walnuts 30 to 100%, chewing gum 35 to 45%, peanut butter 7.5 to 30%, wine for sacramental use 30 to 150%, film exposed but not developed at 0 to 10%, artificial flowers 10 to 20%, kitchenware, tableware, household articles, etc., whatever you import normally 10 to 20%, compressors of air conditioners, compressors of refrigerators 10 to 12%, fans, all kinds of fans 10 to 20%, sprinklers 5 to 7.5%, MP3, MP4, MPEG4 5 to 10%, fingerprint reader and scanner for phone exemption withdrawn, headphones increase in tax, CBUs increase in tax, toys and dolls 20 to 60%, hair clips and combs. Combs are completely irrelevant to me, so I'm very happy about this. 10% to 20%. Trailer for films also exemption withdrawn. So across the board, I've just picked up something which are random and registered. There are so many items, which means what? Intention is very clear. If because of this increase, local manufacturers spurs up, good. If local manufacturer does not spur up, Dabu also coming in, duty coming in. Simple philosophy. You know how custom duty works is that because of this you are buying locally, good, economy will pick up because of that. If you don't buy, you still continue to import, we'll get the revenue. So we'll get the numbers from customs duty. So that's how custom duty is played, and they've effectively played this as far as the rates are concerned. Interesting amendment to the Customs Act. There is something called Section 11. Section 11 confers the power to the central government to prohibit import or export. It's got some 12 reasons why they can do it. One of them is that if it causes injury to the economy. And that clause was confined to gold and silver. Now it covers any other goods. So if import of any other goods or export of any other goods is likely to cause injury to the economy, the government can step in, use Section 11 and simply prohibit. So you will also save foreign exchange, and you will also ensure that the domestic production, the domestic supply is adequately covered. So they have exercised, some of these powers were there from 1962. They realized that they have the powers and they have added that in terms of scope and ambit. Now coming to GST. One major amendment is that government officially declares that GST is yet to settle down after nearly 3 years. July 17 GST came. So the 3 years will end by 31st June 2020. When they originally drafted the act or created the act, they realized that GST can create problems. If there are problems, we can't go back to the parliament each time and amend the law. Therefore, let us have a section which says removal of difficulty. All it requires is an order. So issue one removal of difficulty order and kill the assessee. This fellow is claiming, oh, he is not claiming, amend it. So section amendment, explanation added, if all that is done. For example, take real estate. They just change the value terms to area terms to removal of difficulty order. For exempt supply, just to a removal of difficulty order. For input tax, they change removal of difficulty order. So they use this removal of difficulty order whenever they have a problem and ASSI takes a particular stand or there is a court judgment, they will try to do this. This was all supposed to get over by 30th June 2017. They felt that no, we need 2 more years. So the power to issue a removal of difficulty order continues for 5 years instead of 3 years. This is atrocious. The removal of difficulty power is part of a legislation and you have to allow it to settle down. You can't perpetually add this power and remove difficulty. The difficulty is sometimes created by the law. And you can't say that we have to rectify this law. So that is one. That's a massive change that has happened. Second, as far as GST is concerned, this composition levy under section 10. One of the conditions which was put forth is that you must not be engaged in supply of goods which are not leviable to tax under the Act. There was a lacuna that goods only was covered, service was not covered. So they've added the word services. So they're just exploring where all there is lacuna and trying to amend it. Similarly, there is this peculiar section called section 16.4. All of us have debated this extensively. Section 16.4 says there is a time limit for availment of input tax credit. I have a view which many of you may not agree with. The view which most of you would endorse is that, sir, please read section 16.4. 16.4 says you must claim the input tax credit by the due date for the September month return or the due date for the annual return, whichever is earlier. Therefore, if you take April 18, 19, then your due date had collapsed by October 20th. Even though your annual return is up to 31st March, right? 17, 18, even more old stories. My view is slightly different on this. My view is that if you read section 16.4, it still uses the word section 39. And the return under section 39 can only be GSTR 3. And since GSTR 3 does not exist, the only other date is the annual return. And the annual return date is available. Technically, even 3 more days. 3 more days, Nela Varda Pathite 6 hours, 7 hours, the window. Okay. Somebody was saying people are struggling, our fellows did not sleep overnight, they waited before the portal. Suresh was saying, he's saying you should give suggestions. With due respect to professionals, why do professionals put up with this kind of nonsense? There is no necessity why you should kill yourself and wait before a portal which does not function. It's absolutely unfair. It is unfair to your knowledge, it is unfair to your experience, it is unfair to your intelligence that we'll have to wait for a failure of a technical glitch. And now they're saying, sorry, apology, we are in maintenance for today. We are doing some improving your service till 3 p.m., 4 p.m., etc. The reason is simple. NIC data is active today, budget. Servers are busy. So this can't work. So my feeling is that enough is enough. At some point of time, you have to put up your hand and say that, look, we understand everybody goes through errors, technical glitches are there across. We also have a problem when you go from normal system to ERP or, we convert into a new software mode. But how long? How long can you put up with this kind of thing? Because perpetually you are wasting your time. And therefore something has to be done about it. So in the scenario where you have, and then of course, the portal has got a mind of its own. If this is one part, portal decides to give you credit, it will give you credit. Portal doesn't like you, it will show everything blank. One access denial. Second is, access denial might have been better than seeing the numbers there. So it has its own mind of it, play. So how long can technology just like that override legislation and valuable rights? One side is, of course, you have your retrospective rule, amendment rule 61, all those things. The other thing is the portal. So while I fully understand that we are all in the game to go online, there has to be some limits to which you can put. I think somewhere it need not be through the institute, it can be individually also as a professional. I can understand institutes' compulsions, they may have a different, they are an organization by themselves, they are a body by themselves, they may not be able to put it in so many words, but as a professional, senior professional, you have every right to put it across. If you look at some of the other states, the bar associations and tax associations are filing writ petitions to the court, giving all these details of taking glitches and saying why it's not possible. There are decisions of the Delhi High Court which say that assessee claimed under Tran 1, went to the High Court and said, I claimed under Tran 1, I'm not getting it. Department said, where is the proof? Give me a screenshot that you tried. You have not tried. Assessee simply argued saying that I don't even have all that evidence because I couldn't even enter. Court said that when you on record say that you have taken glitches, it is very much possible that somebody could not have been able to get access to file Tran 1 at that point of time and hence open manually and give it to them. So courts are giving relief. Courts are stepping in. But somewhere I think we have to make our voices heard because this cannot go on. At least in Form 26 in TDS, it is a case of this kind of volume doesn't happen. It is very little. You are able to adjust over a period of time. But your ITC is significant. Your GSTR 2A, which is not there, but there. Right? Legally it is not there, but we'll ask questions. We'll give you notice comparing GST, RPA and everything else. Your export is linked with that. And look at exports. Look at the latest circular. There have been instances of bad exporters. Yes, there will be bad exporters. I don't know if you have read Palkiwala's observation way back. He said, if a shopkeeper is obsessed about pilferage in his shop and completely focuses on only looking at that pilferage, his business will never grow. Same. Like that Hollywood movie which came long back. One fellow was obsessed with the mouse that came into the house and ultimately the house was burnt. You are worried about the 10% fellow who is raising fake invoices. Within the 10%, some fellow is claiming unnecessary refund as an exporter. He is not being an exporter. He is a fraud. Agreed. Why do you make the lives of the rest of the 90 miserable? They are all tax-paying, honest citizens. You can't change the law so drastically and make it so difficult for them, which is what has been continuously happening. So on one side, the FM says that we want country to grow to $5 trillion in 2025. Yes, achievable. When? When you trust business. No sir, I cannot trust because these 10 fellows are bad. Find those 10 fellows and take action. Don't suspect the 90. So what is now happening? The export circular says all exporters, assing officer has to go to the site and verify whether he is there. Not only the company law, I don't know whether you are a company or not. I don't know whether you are a promoter or not. And the vassal or photo எடுத்துக்கோ. ஒரு board எடுத்துட்டு இதா என் company jail மாதிரி. And you upload that photo. These are trust deficits. Why? Because some fellows were fly-by-night operators. Yes, there were frauds. This country has frauds. Just like how they have corrupt politicians, they have frauds also. So you take action against those frauds instead of making like the other story of directors, get your DIN and then OTP. Without OTP you cannot get. Foreign director. You are going to ask that foreign director to give the OTP. And then he says, your RBI fellow says, don't give OTP to anybody. Just because the chartered accountant and the company secretary or any other professional has got a good client relationship, that fellow is sharing. Otherwise, there is no necessity to share. So sometimes we go berserk in all these things. Today also, I am sure in your GST returns, your client has to be in your loop to give the OTP, or virtually the phone is also with you. Sir, sir. Which is probably true in most cases. So while we go online, I understand, we can't make our technology so vulnerable because this is a vulnerability. It's huge vulnerability you're exposing to, and then we get into all kinds of complications. So as far as GST is concerned, they have made some changes as far as section 16.4 by saying that the time limit shall be invoice or debit note. Earlier it was invoice or invoice relating to debit note. So there was some kind of interpretation that debit note is strictly not covered by 16.4. There can be any kind of time limit. So they're trying to plug that loophole by their own language. Then coming to some other amendments as far as GST is concerned, the 140 has been revisited. Section 140, as you know, deals with transition. 140 subsection 1 your SENVAT credits, etc. Then 140 subsection 2 your stock. Every single subsection of 140 has been invaded retrospectively by saying that this shall be within the time prescribed by rules. In one stroke, many decisions have sought to be nullified by saying that the rule is supreme, executive is supreme, parliament is not supreme. Parliament also agrees that they are not supreme by the retrospective amendment. This retrospective in GST is unwarranted. At least GST you should have let it alone. All old laws you have did retrospectively. GST you let it alone and allow the things to grow, but no, they went on against it. Small relief, there was this issue on fish meal from 1717 to 39/2019. They have retrospectively granted the exemption to ensure that there is no impact of taxes concerned. So as far as indirect tax is concerned, I wouldn't say very major amendments have come in terms of substantive changes in law. I am not surprised because the earlier GST amendment itself, half of them is yet to be notified. CGST Amendment Act 2019, most of the amendments are yet to be notified. So where is the question of CGST Amendment Act 20 also, and then getting it notified? Because getting the provision notified is a challenge because 29 states have to pass their act, then only you can bring it into effect because all sections are connected, all provisions are connected. But somewhere, wherever possible, they have done. Where they should do, they have not done anything. GST tribunal. There is a GST tribunal. Today, many of you know that the assing officer issues a GST notice, uploads it. You file a reply. Without hearing, he passes an order, uploads that. And then you run around and find where the appeal is and file an appeal. Now, if the appeal is heard and is dismissed against you, where will you go? You can't go to a tribunal because tribunal has been struck down. Why it has been struck down? Because tribunal had 3 members, 2 of them technical, 1 judicial. So High Court said that this is violative of the law laid down by Supreme Court, both in the compel law matter as well as in the other matters. Supreme Court in Madras Bar Association has continuously held that judicial equality or judicial majority must be there. Have 2, judicial technical, or have majority. You cannot have technical majority. Now that judgment is very critical. That amendment the judgment has nullified the tribunal provisions. Ideally what they should have done, they should have rectified the error pointed out by the Madras High Court and then amended the law to say that judicial will be equal or judicial will be more and then appointed judicial members. But they have not done that. Which means today, if a Commissioner of Appeals decides against you, you can't go on appeal to tribunal. You have to go to High Court on writ petition. How much can you go to High Court? Advance ruling, you have to go to High Court. Anti-profiteering order, you have to go to High Court because there is no appeal provided for anti-profiteering order. So High Court is just flooded with writ petitions. At some point on it becomes painful for them also to handle so much of writ petitions. But that seems to be the way things are going. So coming to some of the finer aspects of the budget, since tax were not significant. A lot of jokes and memes are going around in the market on GDP and things like that. But I would suggest, if you have time, read the economic survey. It's brilliantly articulated. And of course, you have this new Tali related economics. Earlier, our Raghuram Rajan had Dosa related economics. So when they write such lengthy stuff, they probably get hungry, so they get inspired. So it's actually a very good analysis as to how much a thali costs across states in the country. If 2 meals are provided in a 5-member family, what is the rate? It's a brilliant study based on pulses price, oil price, non-veg also, they factored the meat price and everything else and said that this is the rate and this is the savings you have. They've justified by saying you have so much of money in your hand and therefore there's nothing wrong in the policy. The point is, they've touched in a very subtle way that food prices have not been so bad. We've been managed to handle inflation. Now, whether this major amendment, proposed major amendment which they talk about is going to put so much of cash in the hands of the individual that he is going to rush into the market and then buy everything and fill up bring the economy back to its normalcy. You know the answers. That much of money is not provided. But because of the dividend distribution tax abolition, because of increased investment that is a possibility, because of further employment generation that is possible and therefore revenues getting generated, that can trigger consumption. That's a possibility. So it takes time. It is not going to overnight. This budget is not going to overnight change the economy, and budget is just a day event. It is a long-term process. What government should really do is, they should walk the talk and implement what they say. Government keeps saying that we are here to govern. We are limited government, more governance. That is a concept which they keep talking. Please implement that. If you just implement that and stay away from 10 approvals, 6 approvals, 7 declarations, 6 copies, online as well as offline, etc., things will be much better. Thank you for a very patient.
Thank you very much, Vaiti sir. As always, his insights are excellent, his humor is even better. So it's always enjoyable to listen to Vaiti sir. Sir, as a token of our love and affection, we'd like to give you a small memento from our CA Institute. So with this, we reach the conclusion of our session today, budget session. We'll be having another detailed session, clause by clause analysis. This will be happening on 3rd of February. So you're all welcome for that program as well. So I thank the members for joining today. I thank the speakers and I thank the staff as well. Thank you. Have a very good evening.